and things you may hear about on the internet or from friends, and whether they're wrong or right. So, first of all, you get a pay raise. Yay! That's a good thing, right? It bumps you up into the next tax bracket.
You said you want to participate.
Will you end up paying more in tax with the raise or without the raise?
Well, make more money.
Take the raise. Take the raise.
Are you going to pay more in tax than you got in your raise?
No.
Yes.
No.
I guess it depends.
You're
But not
not.
normally.
If you make $30,000, you're in the 15% tax bracket. Most people think of that as 15%, so you're paying $4,500 in taxes. You get a bump up in, you get a raise, you make $40,000, you're in the 25% tax bracket. 25% of $40,000 is $10,000. Are you paying $10,000 versus $4,500, so the raise really makes no difference?
And net of 35.
No. So, I had to put the numbers up because if I just speak them, it will jumble your mind. You're only paying 10% tax on the first $9,000. That's what we call the brackets. And then 15% on the amount between $9,000 and $30,000. So you're really paying $4,050 in the first scenario. You get the raise. You're still paying 10% on the first $9K. You're paying 15% on the amount between $9,000 and $37,000, and then 25% is only on that last $3,000. So you're really only paying $5,800 in taxes. So you get a $10,000 raise, and you pay an additional $1,800 in taxes. So you're still getting an additional $8,200.
Well, that sounds pretty good.
Yeah, it's pretty good, right?
I think it sounds better than you thought it was going to be, right? Take the raise. Okay, I definitely take the raise.
Meals and entertainment. What do we know about these?
Right off.
It's really fun.
You can write them off.
It's really fun.
Can you write them off 100%?
No.
50%, right?
You can try.
So you take a client out to lunch, you can deduct half of that. You bring lunch in for your office, you can deduct half of that. You have a company picnic, you can deduct half of that. Not always the case. For company picnics, you can deduct 100%.
Oh.
If you're bringing lunch in for your employees as an incentive to work extra hours or be more efficient so they don't have to leave the office for lunch, deduct 100%. Myth debunked.
But they never ask you those questions.
They don't. That's one little secret you gotta know.
Two categories then.
Illegal income. Is it taxable? Should you report that on your tax return?
They never see it, they never tax it.
That is a myth.
Trick
Illegal
question.
income is taxable.
It is taxable.
And you're dumb for telling them.
It doesn't matter what you're doing. You still should be reporting and paying taxes on that. If you are selling drugs, you are technically self-employed. You are subject to not only income tax, but self-employment taxes as well. Now, this is not an area the IRS goes after very often, because if you don't care about breaking the law, you probably don't care about paying your taxes. So it's very hard to get money out of it. But it should be reported.
Remember that, Jim.
Yeah.
All right, so you filed your return for the year. It's been processed. You get your refund check. You can no longer be audited at that point. Is that right?
Wrong.
How many years can they audit you?
7.
4.
7, 10.
Probably forever now.
The IRS has 3 years from the date you file your return.
That's
The
it?
Franchise Tax Board has 4 years from the date you file your return.
Oh.
Unless it's grossly misstated. It has to be over 25% wrong for them to be able to go back further.
Really?
We always recommend keeping at least 5 years of documents so you don't have to keep track of when your filing date was. Just makes life easier. But keep your tax returns indefinitely, but the documentation to support those tax returns at least 5 years. So, when you file your tax return, the burden of proof lies with the accountant or the taxpayer.
Taxpayer.
Should be the
What
accountant.
if the accountant makes a mistake? What if you told the accountant you paid $1,000 in meals and medical expenses, and they reported $10,000?
They don't sign the part that says I certify this is true. Sign it.
Yeah.
If it slips by you, you're going to be responsible for the taxes, the penalties, and the interest. It's the burden of proof is not on the accountant.
Oh, that sucks.
Yeah.
This is why it is so very important to be very careful when you're choosing your accountant. You want to be just as careful as when you're choosing your doctor or a lawyer to represent you. It's a very important decision. There are taxpayers out there that commit fraud on purpose in your returns for their benefit. Some things to watch out for. If they charge a fee based on the return they're going to get you, they're definitely putting fraud in there to get you more money, to get themselves more money. If they promise to get you a larger refund than other taxpayers can. The law is the law. If you have two great tax preparers, they're pretty much going to get you the same refund. They're going to do everything correctly. The difference in tax preparers really is in the planning and putting yourself in a better position so you pay less tax, but not on the return that you're looking back on. The numbers are what they are. If they ask you to sign a blank tax return, just run away.
Run, Forrest!
Not a good idea, yeah.
And if they electronically file your return before you've had a chance to review it, if you haven't seen anything and they just say, oh, we'll take care of it, we'll file it, we don't need to send you a copy, don't do it. You never know what's going to be in that return. If you take one look at it, you might realize that they've claimed $1 million in expenses and you couldn't possibly have that. So anyway, those are all my tax myths. I think we debunked some good information today. Thank you very much.